All right, y'all. So we got a lot to talk about in this video. So let's get straight into it. So in this video, we're going to talk about buying a car or having a mortgage versus renting, right? So right here, I have mortgage terms for. I decided to do a 2-2 condo, right? And the reason I'm doing a condo is because I feel like a condo is you can usually get them cheaper. Not in every case, but most cases, a lot of cases, you can get a condo cheaper. So it's a better fit for somebody who's just starting out, trying to get something, trying to get a house or something like that. And I feel like the payments will be lower, so it's easier for you to kind of manage that cash flow, that monthly cash flow, and everything like that, right? So, anyways, let's get into it. So, let's say you purchase a condo, the value is 160,000, right? Purchase it for 160,000. Now, when you're buying a condo or any place, you have to have closing costs for appraisals, inspections, realtor fees, stuff like that. So on average, I'm going to average about like $9,000, right? It can be lower than that. It can be more than that. It all kind of depends, on the situation, right? A lot of things can happen. Um, then you got the down payment, right? So let's say you get 5%. The loan company, right, or the mortgage company or the bank asks you to put down at least 5% for the down payment. So that'll be $8,000. So 5% of 160,000, right? The total cost for the home is 8,000. So that's where you have to come up with your out of your pocket up front. Usually condos you have to put like 5% or more. I don't think they really do like 3.5% like the what they call the FHA whatever. But anyways, we're gonna get into it, right? So the mortgage, after you already paid the $8,000 from the 160, so that leaves 152,000, right? So this $8,000 is kind of like you still have it, because that's the equity that you have in the condo, right? So it's basically like you just made a trade. Like, boom, I give you my cash for $8,000 in cash for $8,000 worth of the property, right? So you still kind of have that. The 9,000, that just went away. Those are just a bunch of fees. But the 8,000 is like you just made in exchange 8,000 worth of dollars, 8,000 for the property, right? So now let's go down here. This area is the monthly payment. The monthly payment that you will have to make, right? Versus rent. It's comparing the mortgage versus renting, right? So let's get right into it. I also have the amortization calculator and the annual amortization schedule over here, because it's going to help us see where I got some of the numbers from, right? So first off, we got the mortgage interest rate, that's 3%. And then we got the monthly mortgage payment at 640.84 cents. And I got that by coming over here using the calculator, right? So the loan amount is going to be 152,000, because you already pay 8,000 out of your pocket, right? So you got 152,000 left to pay, which is what the bank is going to give you in a loan. And let's say that loan term is over 30 years and the interest rate is at 3%. So your monthly pay is going to be 640.84 cents. Now, that is going to include both the interest and the principal. So the interest is pretty much like a fee to the bank for them lending to you, and then the principal is kind of like you paying yourself back. Like it's like you making that exchange for your dollars to the property. But we'll get into that more. So now the monthly insurance, let's say it's around $60. I'm in Florida, South Florida, so I'm basing everything kind of off where I'm at. It may be cheaper, it may be more where you at. So you have to do the numbers yourself, right? So on average, this is what it'll be around. The monthly insurance will be around like $60 a month, right? For this type of property. The PMI insurance, again, is on average going to be around like $30. a month for this type of property. The property taxes, $175 on average for this type of property. Monthly repair and maintenance. So the monthly repair and maintenance people kind of say a rule of thumb is to budget for like 1% of your house value. So I took this $160,000, right, and then I multiplied that by 1%, which gives me $1,600, and then I divide that $1,600 divided by the 12 months in the year, which gave me like $133, right? So that's what they budget for. It could be less, it could be more, right? You may not get repairs at all, so, but this is what you want to kind of budget for, right? Then a monthly HOA is $400. Again, this is on average, these kind of condos, it'll be around, monthly HOA probably be around like $400. Now this is for condos, this is not for a regular house, right? But the HOA, and then keep in mind too, for a condo, the repair and maintenance may be even less. Well, no, I'm not gonna say that. So the monthly HOA is $400, right? And so with all of that, the monthly payment will come up roughly around $1,438, right? That's the total monthly payment, right? If you account for everything, right? And so the rent for a 2-2 condo in South Florida is roughly gonna be like $1,700. This is probably like the cheapest you're gonna get, especially right now. The prices are crazy right now, so it's roughly gonna be around like $1,700, right? So now there's a difference in this is how much you save for renting rather than for having a mortgage rather than renting, right? If everything falls in line kind of with this is how much you'll be saving a month, like $261. So then we're gonna look at the net return after 1 year, well, 1, 2, and then 3 years, right? Just to see some things over the years. So the upfront cost of buying the house is going to be $9,000. That $9,000 is for the closing costs, the appraisal, inspection, realtor fees, all of that, right? Could be less, could be more. It's roughly not going to be too much more than that, even if it is more, right? Then you have the rent, right? So the rent is this is for like the application fee, the credit check, and all that stuff. Roughly, it'd be around like $500. And then you have the beginning equity, so that's $8,000. So your equity is because you put a down payment on the house, right? So that's $8,000. So the only thing with this is that you can't use it because it's tied up in the house, right? So that's $8,000 you kind of can't use. So that's one of the cons that go with having a mortgage. But then the rent is $8,000 as well, because you kept $8,000 because you didn't buy a house. The only thing you will have to worry about is the first and last month deposits, right? But we're not going to really talk about that in this. And then so let's go down. You have the mortgage / rent costs, right? So this number right here is a little tricky. It is pretty much the insurance, right? The monthly insurance, and then you got the PMI insurance, property taxes, repair and maintenance, and the HOA, right? All of these things right here, because all this money is going to someone else. That's just fees. It's just a bunch of fees, right? And then also within this monthly mortgage payment is the interest. So you have the principal and you have the interest, right, when you making that mortgage payment. So all of this $14,000 is all of these added up over 12 months plus the interest from this monthly mortgage payment over 12 months. And so if we go over here to the right, that interest for the first year would be roughly $4,500. So all of that, right, and is gives you $14,000. Now the rent is the $1,700 times the 12 months, so that'll be $20,400. So all of this is going to the landlord. Then you got the equity build up, I call it. So the equity build up is the principal of the mortgage payment over 12 years. So that $3,173 comes from right here. $3,173 for the first year. That's pretty much like you paid yourself, because what you did was you just said, when you pay the bank, you're saying, hey, I'm taking my money, I'm paying you, bank, to give me, like, in exchange, I want some of my property. So it's basically, you just said, hey, bank, I'm paying you, boom, give you my dollars for a piece of the property, right? So you're just buying your property down, pretty much. So that's why I call it like the equity build up. You're building equity, right? Then you got the cash save. So this cash save is the rent minus the mortgage. So that rent minus the mortgage, which gives you $261. $261 times the 12 months will give you around $3,100. Then you got the annual appreciation. So I kept it at a conservative 1%, right? The home value times like 1%. I kept the appreciation around that much, right? This is conservative, but sometimes you may have a year the house could appreciate, the house might not appreciate really, but over time is pretty much going to appreciate. So let's say over a year, that 1% is the $160,000, the value of the condo, times 1%, which gives you $1,600, right? So adding up all of these will give you a net return of negative $7,185. So ultimately you lost money, right? But rent, you lost $12,900. So mortgage, with the mortgage, you lost less, right? You lost almost double with rent, you see. So right, that's just something to keep in mind. And then over net return after 2 years, so these are pretty much the same numbers. It's just now everything is accumulated for 24 months, right? So the upfront cost is the same, $9,000, negative $9,000, negative $500. Then you have the beginning equity, which is the down payment again, which is $8,000, right? And then that's the same for both, right? Then you got the mortgage rent cost. So that mortgage rent cost is all of these: the insurance, property taxes, the PMI insurance, property taxes, repair and maintenance, HOA, all of that, by times 24 months now, right? 24 months, right? Plus the interest for the 2 years. So that 4,500 and the 4,420 right there. I don't know if you can see it. Let me try to make it a little bigger. I think I can make it bigger. But yeah, those 4,500 and the 4,400, right? All of that is added in here, right there. So that's negative $28,000 that you paid, a bunch of fees, right? And then for the rent, that's just the rent cost. The $1,700 times 24 months, which gives you $40,800. And then the equity buildup is the principal, right, for the first 2 years. So that's the $3,100 plus the $3,200. So now you're at $6,400. And then the cash save is this $261 times 24 months, which gives you $6,200, right? And then the annual appreciation is the 1%. The 1% over 24 months now. This is compounded over 24 months, right? The annual appreciation compounded at 1% over 24 months. So that'll give you a net return of negative $13,000, and but the rent is negative $3,300, right, after the 2 years, right? So you can see, you're losing a lot of money. with the rent. You're losing more money. And so now with the third year, man, I don't think I can. Okay, so the third year, now all of these numbers, it's the same thing, but just over 36 months now. So I'm not going to go through all of this again. I hope you understand like what I was saying before in the first 2 years. But pretty much the returns, let's just look at the returns. So the returns are negative 18,922 for the mortgage, and then negative $53,700 for renting, right? So this is, it's almost triple the return, the loss is almost triple for the rent versus the mortgage. And so now at the bottom, let's go over the pros and cons. So for the mortgage, the pros are you get to save monthly cash, right? Because it's less than the rent. Even with like the repairs and all that stuff, it's gonna be less typically, right? And it could be less, but it could also be more. It all depends on the situation, how you do the numbers. You have to vet the property that you're buying, right? But typically it is, most of the time it's gonna be less. Then you get to pay yourself monthly, because when you're making those payments to the loan, for the loan, some of it is going for interest, which is like the fee to the bank, but then some of it is also you're basically exchanging your dollars for the property, the equity in the property, right? So it's like you're paying yourself in a sense. And then so right here also it builds equity, because again, as you're making those payments, you're building equity in the home, right? And then it also can appreciate in value, right? Condos typically will appreciate slower than like a house, but nonetheless it'll still appreciate. That's not to say it's always going to appreciate, like, they may not appreciate for 1 year or something like that. So just be aware of that. And then the monthly payment is fixed, so it's like when you get that loan and it's a fixed interest rate, that's it. Like there's no bank raising the loan on you. That's not going to happen. Now you do have to worry about like property taxes can increase, right? So that could have been down here. Property taxes can increase, stuff like that, But so that's something you kind of have to look at too. Then you have the rent. The pros for the rent is less upfront costs, so you don't have to pay closing costs and stuff like that. No appraisals, no inspections, nothing like that, right? And there also are no big home repairs. So that's not to say that with a house you have big home repairs, especially with a condo. You might not have big home repairs, but condos do have what they call like assessments every couple of years. So the repairs for the condo, they may add something extra to your monthly payment to fund the improvements for the condo facility, right? Then you got the cons down here for the mortgage. You'll have high upfront costs. Closing costs can be a lot. And then as you saw in the example, right, about $9,000 in this example. Could be less though. And then you may have home repairs, right? You may have home repairs, but usually on the inside of a small condo, you probably not gonna have that many home repairs like that. And then if it's a condo, HOA can increase. So like sometimes if there are some improvements that need to be made, or let's say like the water bill, the accounting department of the HOA has seen that the water bill has increased over the years, the past couple of months. The HOA can increase, stuff like that. And then so that's something to think about too. And then the rent, the cons for the rent is the rent can increase, right? But the rent can increase typically more than HOA. But I mean, it all depends. And then the cons for renting is another con is the entire payment goes to someone else. So at least with the mortgage, some of it is coming to you. You're just making that exchange from your cash to get the value of the property. But this, like, the entire thing is going to someone else. So you can look at these returns and decide which is better for you. As you can see with this though, even if like some of these things increase, like the HOA increased, and what else, like maybe you have some things to fix in the house, whatever, there's still a lot more room left versus the rent. Like the rent, you lose after 3 years. Your net return is around like negative $53,000. This is like, it's nowhere near that. So you still not, you're gonna come out on top. You still gonna come out with a better return, really, if you rent, you know. But the only thing to keep in mind is one thing to keep in mind is the upfront costs. So the appraisal, all the closing costs, that's money that you can't use for other things. You can't invest. That's a lot of money going out at once. So that's something you want to keep in mind too, But yeah, so everybody's situation is different. So you have to, kind of make your own decision. I'm not a financial advisor. This is not financial advice, but yeah, I hope this, kind of gave you guys some good insight. But I don't want to make this video too long, so thank you guys for watching. I'll see you in the next one.